Welcome back to Wealth Mavericks, the only show where we talk about the secrets the wealthy know to build generational wealth. And on today's episode, we're talking about tax credits versus tax deductions. What's the difference and why does it matter to you?
That employee is designed to generate revenue for your business, but also generates revenue for the IRS. So when the IRS invests in you as a business and you hire an employee, it generates cash flow for the government.
There is a right answer. This is the one that's going to give you the biggest deduction or give you the biggest credit. Like your point is in the mindset of the business owner is saying, let us focus on that kind of thing,
Correct.
give you good advice. You focus on running your business to the optimal levels. So I'm excited about today's episode. It's a simple topic, Bob, but it's something that I think a lot of people don't understand. I know when I was running my business, there were some, I thought, tax credits that we were getting that were actually deductions, and that actually had a pretty big impact in my world. So I'm excited for you to share your knowledge in this world. And today, if you hear a difference in my voice, it's because we're taking the show on the road. I'm not in my office, so if the sound is a little bit off, that's what's going on today. But I know we're recording this episode as we're wrapping up the year. Bob, how's everything going for you as we're wrapping up the year?
This time of year is always interesting. It's, we got a few more days left, and it's exciting in the planning process with our members and the people and the advisors that we're working with around the country. But then it's also when I have, it sounds silly, but when I have a downtime, during this period of time, I feel like I'm wasting my time because there's so many people we can help.
Right.
And just being in a situation where, um, want to help people. You want to help more and more and get the message out there and just realize that. And there's a lot of people we've talked to, you and I've been on calls together, and people just, there's almost that feeling of we care more than they care at this moment,
Right.
until they actually are writing that check to the IRS. And then they're like, oh, well, maybe I should have listened to those guys 4 months ago. And at that point, it is what it is, but which I hate that phrase, but it
Yeah.
is what it is.
Well, that is what it is, and it's nothing else. So, well, talk to us about, I think a lot of people are certainly familiar with the terms of deductions and credits,
Yeah.
but what is the difference? Like especially from a business owner's perspective?
Yeah. So it's interesting, and that the tax credit world is probably just as big as the deduction world.
Hmm.
We've had this conversation before, and we've said it here on this show, and we say it all the time, is that the IRS really isn't our adversary. They're not our adversary. They really are a business partner, and the government, when they pass laws, and it's the IRS, the Treasury Department's job, aka the IRS, to figure out what law was just passed and how are we going to communicate to the taxpayer what this means, and then how are we going to enforce it and collect it. And so when we look at the two, credits and deductions, both these worlds are so big, but the explanation is so simple. And
Hmm.
so let's talk about the explanation first, and then we'll kind of dive into a couple little different things, maybe some credits that people are familiar with or have heard, but they're like, well, what's that mean to me? And then
Hmm.
maybe we can talk about a little bit of what's that mean from a dollar perspective. Okay.
Sounds good.
So a tax deduction, we'll start with that because that is more of a familiar terminology that most people have. And that a deduction is literally just we have revenue, we have an expense. That expense gets deducted from our revenue, meaning that we're not going to pay taxes on that expense, but it's calculated based on our tax bracket percentage. Okay.
Okay.
So for example, if I'm a S corp, which is a pass through, that means any profit or loss for my business is going to be passed down to me. So let's say I have 200,000 in profit, gets passed down to me as a individual taxpayer, as a sole owner of that S corporation. Okay. So that 200,000 now is my income. That's part of it. And it goes, remember, we've talked about the first page of the 1040, and it's a summarization of all incomes, positive and negatives.
Hmm.
So that 200,000 is now added as income. But all the expenses that occurred from the revenue I generated as a business, the expenses were subtracted. Those are deductions. Now, not all expenses are deducted as a full dollar amount. For
Hmm.
example, meals and entertainment. And these change year to year. So if you're listening to this and I say something and you're going, well, no, that's different today. Yeah, because tax code changes and
Hmm.
it's only permanent until the next change. Um,
Right.
love the language. Um, so so meals and entertainment. You're only allowed to, so if you and I go out to lunch, we spend $100. We're only allowed to deduct 50% of that. So $50 will be considered a deductible expense, meaning that other 50 is going to be considered part of that profit that flows down on my profit and loss.
Right.
Okay.
And you've talked about this before, even the fact that they allow you to have deductions and not we're not paying taxes on the full amount of revenue that gets generated. We really are paying taxes on the profit after all of the expenses happen. And in this world, this is called a deduction,
Yeah,
right?
yeah, yeah. And it's a huge thing if you think about it, because the government can very easily say, we need tax revenue. We're going to actually tax everybody at their top line revenue.
Mm-hmm.
And there are states that actually do that.
Hmm.
Texas is one of them.
Really?
Yeah. But if you're between 0 and 10 million in revenue, you don't pay any taxes
Hmm.
from a business perspective.
Right.
If you're over that, then you pay a percentage of the revenue above that.
Hmm.
Okay.
So they've got like a business progressive tax system in Texas. What other states, or can you think of others?
There are other states and they're all different with different, it's kind of like for each state it's different on how they address it. And
Hmm.
actually some of them will do like what the government does where it's net and they'll allow you to take the deductions and that sort of stuff. But if you're a business owner and you're making anywhere from 0 to 10 million and you're not paying any taxes on that, there's profit that's going to flow down to you as an individual that you're going to pay federal taxes on.
Hmm.
The state of Texas doesn't have an income tax. So really the state of Texas is saying, hey, we're giving you a big gimme,
Right.
right? But if your business is over this amount, well, you really should be paying taxes. And that's kind of
And it's just on that amount over the 10 million. So
correct.
that's really interesting because that's a lot of the work that we do is helping businesses go from where they start to over $10 million
Hmm.
in
Hmm.
revenue.
Hmm.
And so that's part of the planning process is, hey, we now are going to have to account for a reduced, return to you based
Hmm.
on the state tax. That's interesting.
Hmm. And I see from a personal income perspective, like I originally from California, and so most middle class Californians are at a 9%, 10% state tax, income
Hmm.
tax. So just leaving California, I got a 10% raise, and all of our
Wow.
businesses are under 10 million, so we're not paying any taxes on that. So when you look at it, it is part of the planning process, right? For
Hmm.
me as a
Right.
tax planner, I couldn't stay in the state of California and tell people across the country that I'm going to help you save money on taxes when I willfully stayed and paid an extra percentage to the state of California and all the other taxes that the state of California has, and say you should listen to me as a tax planner,
Right.
right? It's I feel, Joe, that one of the things that it's there's working with us is really in the details. There's decisions we make because we want you to do what we have done, not
Hmm.
because what you should do because of what this says,
Hmm.
right? And so when you're looking at deductions, yeah, you have the opportunity to use all the deductions that are within IRS guidelines. Absolutely. Now, we were talking earlier is, well, what's the difference between buying a car, leasing? You have a lot of business owners that have that debate and stuff. And for me, it's like it's a deduction. Who cares which one you do? Who cares? Just spend your time focusing on growing your business, less time on wondering, should I be doing this? It's such a
Hmm.
minor issue. When you look at most payments of a lease or a purchased vehicle, you're looking at $500 to $1,000 a month. That's $6,000 to $12,000 a year. Most people will say, well, that's very significant. Yeah, go get another deal and you're done,
Hmm.
right? Go get another client and you got the profit to pay for that
Right.
with the amount of time you focus on, should I do this? right?
Well, and part of it is it's not because we don't know what the quote unquote right answer is. There is a right answer. This
Yeah,
is the one that's going to give you the biggest deduction or give you the biggest credit. Like there is a correct answer. Your point is in the mindset of the business owner is saying, let us focus on that kind of thing, give
correct.
you good advice, on what to do, and then you focus on running your business to the optimal levels.
Correct. So, I mean, the very first thing for me would be cash flow,
Mm-hmm.
right? Are you a business that has healthy cash flow? Well, then, yeah, maybe you should buy. If your business is not and you don't have healthy cash flow, don't put that debt on your books. Just go
Mm-hmm.
lease. It's a payment. It's no different than the electricity bill and or your rent. It's just a single line cost. It doesn't go anywhere else on any of your financials,
Right.
right?
So the bottom line is like get focused on the things that for you as a business owner, get focused on the things that are going to generate more revenue or increase the efficiency in your company to take you to the next level.
Correct.
Rather than did I maximize this element of this deduction, getting the big things right and then not focusing on, the minutia.
That's right.
So deductions, like as a general rule, it's expenses that happen from your business that you're allowed to reduce the amount of money that you're paying taxes on.
Correct. Correct.
Okay.
It's actual activities in your business.
Okay.
Now, transactional activities. Now,
Mm-hmm.
that is also with credits,
Mm-hmm.
but with credits, it's a dollar for dollar benefit. It's not a percentage. It's a dollar for dollar benefit. So what'll happen is you hear these energy efficient credits, employee retention credit, research and development credit, right? You have these various credits, new business startup credit, right? These are various credits that if the government's going to give you a dollar for a dollar, I make a dollar revenue, I'm going to give you as a government a dollar credit, not a percentage like deductions, but dollar for dollar.
Mm-hmm.
Okay. There's rules, right? There's guidelines. There's qualifications, and that's the key is qualifications. With credits, you need to qualify and have those credits be a qualification within your business. So, for example, R&D tax credits. If I don't do anything unique, then I can't qualify for an R&D tax credit. If I do something unique, but it's just me and I have no employees, I don't meet that criteria.
Hmm.
And you as an owner aren't counted as an employee.
Hmm. Even if you're paying yourself a W-2.
That's correct. You have to have at least a separate employee that is not yourself.
Okay.
Right. And the government does this because they don't want you to pay yourself a W-2 to get a dollar for dollar credit.
Mm-hmm.
Right. That you need to create tax revenue, hire an employee, you're creating tax revenue with some other human being. We're going to give you this criteria. You've qualified. Right.
Which I think that does go back
It's
to really,
fair.
and understanding the IRS, and you've talked about this a lot. Like they give us these because they know we as business owners in our DNA is wanting to move our business or businesses forward, and so we are going to take that money that they give us and we're going to reinvest it in our company or in the economy in that way, and then we're going to create more taxpayers. So it really does fall in line with what your core belief is about why they work with us in this way.
Yeah, yeah. I mean, it's, we could maybe equate it to like another asset.
Mm-hmm.
Maybe like real estate as an example, right? When you buy a apartment complex, if you don't rent out the apartments, you're not generating a revenue. You're not an asset,
Mm-hmm.
right? But as you generate and rent in each unit you rent out, that's like hiring an employee in your business. That employee is designed to generate revenue for your business, but also generates revenue for the IRS. So when an IRS invests in you as a business, you piece of property, real estate, and you hire an employee, rent out a unit, it generates cash flow for the government,
Mm-hmm.
right? So the government's not doing anything different. It's like we were saying before in the details when you hire us, we're saying do what we're doing. We're not telling you
Mm-hmm.
to go buy Coca-Cola shares and we don't even drink Coca-Cola. Well, it's
Right.
good for you, but just not really good for me. Well, if it's
Mm-hmm.
not good for you, why is it good for me? right?
Right.
Where's your skin in the game, right? So, anyways, I digressed a little bit. So, when you look at the credits, there are criterias, and it's because they are gifts, right? It's for those video gamers. I don't play video games, but I did as a kid, and Legend of Zelda and Mario Brothers and all that kind of stuff. When you go through, there's certain things that you can do that you get a reward, right? The IRS is saying the same thing. If you go down this pathway and you qualify and you find this reward, you got to have a key to unlock this treasure chest, right? And if you have the key, qualifications, you get to unlock this treasure chest and you get whatever in this treasure chest.
Right.
Awesome. And then you level up, you go to the next, and you keep going, right? And that's essentially what the government does for us. They're gamifying business to create more tax revenue for them.
And you've got to understand the game, and that's part of
Yeah.
where people, I think, get lost, is because it's not an easy video game to play. It's
It's
not,
not.
and it's boring. It's a boring video game to
Yeah,
play.
yeah, yeah.
So at a core, if we were to use an example.
So because you still have a tax bill, you still have credits. I mean, taxes. So
Mhm.
here's an example. Okay, so we have 10,000 in deductions. If your AGI was 100,000. Okay, and remember, this is an individual. Okay, so we
Okay.
had 10,000 in deductions. We had $90,000 in taxable income. We're at a 25% tax rate. We paid 22,500. Okay, no
Mhm.
credits. Tax bill 22,500. Now we get 10,000 in credits, so our AGI is still 100,000. Now remember, this is going side by side as an example. So now we have taxable income still as 100,000. Well, that's what we said before. We still have taxable income as 50,000 from our business as a profit, right?
Mhm.
On each side. So we have our tax rate. So here's that credit dollar for dollar off your calculated tax.
Right.
Okay.
That's what I was saying.
Yeah.
So it actually comes off of your tax bill, not off of like AGI. It actually comes off your tax bill.
But here's the thing is that most credits aren't going to give you money because in our example, we said we had the
Right.
profit, right? Credits aren't going to give you more money than what you've paid into it. It's giving you your tax dollars back, so to speak,
Right.
right?
Yeah. So in that scenario, if it was $100,000, we'll keep the same scenario. So your business has deductions that drops your profit to 50,000. You would have paid $5,000, but the tax credit allows that to drop to zero
Correct.
because the credit came in.
Correct. Now, here's the thing is that with some credits, the government actually allows you to go back 3 years to amend previous tax returns.
Uh-huh.
Okay. Some states will allow you to do the same. For example, California allows you to go back 4 years. Okay.
Mm-hmm.
And what this means is that if you qualify for credits that you didn't claim,
Mm-hmm.
the government, the IRS, your business partner is saying, hey, you can actually go back and look at the last three years and requalify or qualify for those credits for those 3 years. Just file an amendment and we'll refund you tax dollars based on
What
the
you
credits,
paid.
what you paid,
Right.
right? But you had to have paid money into it. If you
Right.
paid no taxes the last 3 years, you're not getting a credit for anything, right? They're not just
Right.
going to cut you a check.
Right.
Okay.
It doesn't bring you to a negative. It could drop you to zero, but that's as far as it can go.
That's right. That's right.
That's
Now,
interesting. From a
sorry.
strategy, oh, go ahead.
I was going to say, but it will, what it will do too, is it will add to your balance of tax owed. What I mean that is that it could carry forward.
Mm-hmm.
So if I got a tax refund and I still had $10,000 credits left over, I can carry forward those to the next year. They subtract that 10,000 the next year, and then the
Got it.
remaining amount is. So you don't
I
lose
see.
them. And it's the same thing with losses in a business. If you qualify for losses, you're allowed to carry forward based on your cost basis on a pass through. And if you're a C corp, you have carry forward, and you're allowed to carry forward a certain amount of losses moving forward as well.
Right.
So there's a lot of little nuances and stuff that are important to know, and most accountants know this stuff. They
Hmm.
don't know about, hey, I can go qualify for taxes or credits and go back. A lot of them don't know you can go back. They don't know a lot of these exist that you can do. A lot of them don't know you qualify as a business for these. This is a
Hmm.
highly specialized tax credits, really is a highly specialized area of the tax code that there are tax professionals, that's all they focus on. That's
It's
it.
just how to qualify for and claim tax credits.
Right. So if you're
Right.
using, Susie Smith CPA, she's working out of her house, nothing wrong with that. And you're, one of maybe 30 business owners she works with, and she's got 500 individual tax returns. Susie Smith really may not know anything about tax credits and that they even exist and how to claim them,
Right.
because her
So
job is to really prep your taxes.
you have to find a specialist,
Correct.
who works in this, because they
Correct.
know the nuance. Like, and I think you've said this before, it's like that specific law that allows, or bill that was passed that allows that credit. Somebody has to go in and study everything about that section of the code that allows a business owner to do that. And you cannot specialize in everything. That would defeat the term of being specialized.
Yeah.
You're a
Yeah.
generalist.
Yeah.
So really, really smart generalists typically have specialists that they work with.
Yeah.
So I mean, from a strategy perspective as a business owner, is it wise for you to just make sure that you always have an employee that you are paying so that you do qualify for some of these things? Or like, is it one? And maybe this is, a question for the specialist, but like, if you have one employee, you now qualify, it like it unlocks the door to all these credits versus like, hey, things are really tight and I need to let everybody go. Does that make sense? Like from a
Yeah, yeah.
strategy
It,
perspective?
it, it could be because you could get enough benefit to pay half of an employee's payroll,
Right.
depending on what you're paying them, right? Or whatever it looks like. So there, and I think that would be a question or a strategy that is, hey, let's see what your situation looks like, and let's kind of bring the team in and let's
Hmm.
look at the numbers before we make a decision.
That's a good point, because I know oftentimes business owners, especially small business owners, we are making decisions on the fly, and we are
Yeah,
making decisions that feel life or death in the moment and can sometimes be really stressful. And obviously, when you have to let people go, that can be a really stressful moment. The reasons why you're having to let people go, if it's financially motivated, feel very onerous. And so taking a pause, taking a moment and just saying, let me talk to my team. Let me
correct.
make sure that I do this. And I think
Yeah.
that's part of the bottom line, is like, do you have a team that you really trust? Well, this is really helpful, Bob. I know there's a lot more conversation to be had about this, both in specific examples that you and I had, and so in our members only content, we're going to continue on with this conversation. But I hope you've gained something from our conversation today, just understanding the general dynamics of deductions versus credits. Make sure to join us on our next episode. We're going to talk about tax loss harvesting. So, how to turn your losses into gains, or at least into a smaller tax bill. So, as always, we appreciate you being here with us today. If you want to be part of the conversation, join us over on LinkedIn or our Facebook pages. Leave a comment. Let us know what you thought, and more importantly, what questions you have.